What is the ideal blend of treasuries and investment-grade corporate bonds in a long-term portfolio? And the second part, any necessity for or significant benefit from an international bond holding in a long-term portfolio? I think you can probably answer the second one in one word, right?
Well, the international thing kind of mystifies me. It's not going to make much difference what you do as long as international bonds have the same, quality and protective nature that U.S. bonds do. So, there's some question I just don't have a good answer to, and that's one of them. I think it comes down to a preference. I do think that it's maybe a little bit peremptory to put these holdings of international bonds and international stocks into the retirement plans, target date retirement funds, without asking stockholders would they like it, because they're quite large dimensions. It's, I think, Mike will have to correct me here, but maybe 35% international stocks relative to stock position, and 35% international bonds relative to bond position, something like that, Mike? 30 and 30? 40 and 30. I mean, that's a big change. And if they all do the same, it's fine. But, and I hope somebody talked about it, even thinking of having a target date funds that are U.S. oriented and target date funds that are world oriented. Funds are large enough easily to accommodate that. But in any event, that's not the way it happened. And I think we should always have options available that don't encompass international stocks and bonds. It's an important choice, and whether there's going to be a big difference, I don't know. But my intuition, maybe I'm just proud to be an American, or at least I know I'm free. There's a song that goes that way called "God Bless the USA," which I will say to all of you, God bless the USA too. Big part of our family culture. And the first part was,
what is the ideal blend of treasuries and investment-grade corporate bonds in a long-term portfolio?
Well, I have always said the best blend is not, and this talks about, intuition and not maybe thinking things quite through adequately, which is certainly what I have done. And that is when we started the bond fund, I just took the bond index. I figured it was represented. And it turns out it's 70% in treasuries and government-guaranteed mortgages. And that didn't matter much in those days because the yields were running around 8%. But today it matters quite a bit. So you start and reflect, times have changed. And I would think it would be desirable to have a fund like that, just top of the head, maybe 50% high-grade corporates and 50% treasuries and other government-backed mortgage, 50-50, just for the fun of it. But those corporates are now only about 30. So a better representation for a higher yield, and higher yield will lead to a longer return, holding everything else equal in the long run, as we all know. And somebody says, well, that doesn't match the allocation of the index. Well, wait a minute, pal. Where do you think that balanced index fund came from? When I started that, 1993, I think it was, I said 60-40. I didn't spend a lot of time thinking about it, but that seemed like a reasonable number. And there's no 60-40 index, except for the index fund, which is the standard. And so some of this, I think we can overthink. Well, having said that, I made a lot of mistakes in doing all the things I've done. And sometimes intuition doesn't work as well as I think. Sometimes my self-confidence is a little bit on the high side compared to what turns out. I mentioned picking that quantitative manager. So I've had some failures, funds that we started that didn't do anything, and so I don't have a good answer. But I do think there should be available to investors who want to take the extra risk in these days of very low yielding bonds. If you want to take a little bit of extra risk, you can do it now, by the way, by just owning a treasury fund and our corporate bond, high-grade corporate bond index fund, and it'll do fine. But people don't seem to like to do that, and it's hard to explain on the phone. Telemarketing is difficult when you've got to explain things to everybody. So I think I think it's a good idea, but hard to implement.
Glenn says, I agree with Jack's critique of the total bond index tracking. How likely is it to change? And if not, what funds should we add to our portfolio to get better corporate exposure?
Well, good question, and I want to emphasize that I may be a little bit of a purist on this. The differences are not large between us. I'd say the index properly weighted. We have things like 25% of all treasuries are held by China and Japan, a little bit from UK, I think. And so why are they counted when the idea is how are you going to perform relative to your neighbors? Let's call it U.S. pension and retirement plans and U.S. investors generally. They just aren't part of that equation. And people can disagree with that, fine, but that's my position. And then they have a lot of shorter term treasuries that I think are much more accurately kind of in the short bill or very medium, less than short term government bonds, and they're in the index. Why would anybody want to be that short? That said, the differences are not huge. That doesn't mean you shouldn't be striving for perfection, even though you'll never get there. But the option is, I think, and I actually did this when the spreads got so wide. It was a very rare move for me to make. I moved a fair amount of my money out of total bond market into corporate intermediate term index, and and that's done fine. I mean, all those gaps of 2008 have been pretty much ironed out. I'm not sure it matters that much anymore, but I just leave it in there. So there is an option of corporate intermediates, and I'm trying to think here, and I'm probably slipping a little bit. It could be a fund run by Welling and Active, but it's an index fund. It's going to have a correlation of 98 or 99 with the index, whether we call it active management or not. And that's, I want to double underscore, when you talk about ETFs starting to have more and more active management, every single one except, I think, one so far is a bond fund. An active management, a bond fund, is day and night different from active management of a stock fund. Bond fund, the tolerances are like this between active and index. In an equity fund, the tolerances are more like this between the high and low around that. So that's what you can do if you want to do it. Although I think we need to lend a hand to the investor, who probably many of you in this room are dying for more income, and yet my philosophy is, if you're in the bond market, don't reach for more yield than the bond market is prepared to provide you with. It's like, to use a very trite example, like crawling out in a limb. You crawl out further and further and you're fine, and then all of a sudden, one step too far, snap. A vigorous metaphor. And so it's, do it a little bit if you want to. I don't. It's not a significant exception in my opinion that I have done. But basically, the market returns a certain amount, and you just have to accept that. Don't reach for more. It's a little bit like somebody that was out, an analogy I used. Someone has lost the first 7 of the 8 races on the card. I think there are 8 races on the card. I go to the racetracks. And like taking every penny you have and betting it on the long shot in the 8th race. When you may recoup, the odds do not favor you. So try and stay within the simplicity, low-cost index, bond stock, and the like.
Here's a related question from Dan Smith. He says, total bond is what it is, and the index it tracks is what it is, and my circumstances have not changed. How do I decide whether or not to hold my positions as long as I live, to put it one way, or hunker down in the Barclays aggregate, to put it another?
Well, basically, I'd go for hunkering down where you are. These relative yields will change. The one thing we do know is today's yield has a 91% correlation, and we'll continue to have a 91% correlation, more or less, with the returns you'll get over the next 10 years. So if you buy a government bond today at 3%, the corporate bond at 4%, 4.5%, the odds are very high that you'll get a 4.5% return over the next 10 years or 3% return over the next 10 years. And so it favors getting a little more aggressive on the yield side. That said, we all have, I try and take, and it's impossible to do, the idea of human behavior in all this. How will investors react? And I'm afraid that once you get a little opportunistic and reach out for something else, you'll be much too insensitized to the prices that the bond fund has. The bond funds have gone down a lot, although the reality is they haven't gone down nearly as much. And you read these scare things. This is a very important point. These scare things in the paper about what a terrible year this is for bonds. And I can tell you in my own experience, the way I do it, my bond portfolio has gone down 0.9% this year. And that's because I have half in the munis are my direct holdings, tax-free muni funds, Vanguard tax-free munis. And the limited term fund is down 0.1%, and the intermediate term, I don't do long because it's behavioral reasons. I don't want to mess myself up. Is about 1.8%. So you put 50-50 in, you can see it's going to be 4.9, and that's a trial over for me. And I wish I'd had everything in stocks. I always wish things like that. I always wish I'd had everything in the best performing asset. But my magic, such as it may be, is I never act in those beliefs. And that's really an important thing. And don't let your behavior overcome. At the lows in February, a little bit like the story I told you about Gus last night, I was scared. Why wouldn't I be scared? I mean, everybody must be scared. So when you're scared and say, I really want to do something about this, I go back and read my books. They might put me to sleep a little bit, but